Welcome to another episode of the Financially Free Physician Podcast. I'm your host, Sim Terwilliger, and today I am joined by my colleague, Megan McGuire.
Thanks for having me today.
Absolutely.
I'm honored.
We are going to be chatting all things childcare costs and fur baby costs because let's face it, a lot of people have fur babies in lieu of or while they're waiting to have children. So, Megan, tell us about your fur babies.
I am a no-child household right now, hoping that will change in the future. But we have two pups. They are treated like our children. I wish I could get a childcare deduction for them, but no, that doesn't exist. I'll share what I do.
No tax benefits for your fur babies. I do know of folks who have hired like estate planning attorneys to do very advanced estate
Yes.
planning for their dogs and make sure that they're well cared for after, their untimely demise and setting up trusts. And have you done that?
So I have not, admittedly. I probably should at least put something in writing for like who they would go to if, heaven forbid something were to happen to me and my husband. But I do have a good friend. She's an attorney herself. So of course she was going to write out like her own like really good documents for what she wanted to happen with her pup. And she does have a trust established for her dog, for the person who's going to be taking care of her dog in the event of her passing. Like they've got the money and resources to be able to give her the same standard of care that she was used to, which I think is really cool.
That's very sweet. Sorry that you guys don't get those benefits. We will talk about some though for human children coming up here. I will say as a mom of two boys, twin boys, that the benefits are so small compared to like the expenses that we incur, but maybe that's just stating the
Mhm.
obvious.
I think people do get maybe excited about like what is that shirt that one of our other partners had said she got her, I think niece or nephew or something who was born on like December 31st. Do you remember what I'm talking about?
It was like just in the nick of time, like that family's going to get that tax credit. But I don't remember what the shirt.
Yeah, it said something to that effect, like my mom and dad's best like tax deduction or something like that. So, but yeah, people get excited about tax benefits, of course, because people love like saving money on taxes, and kids are a way, but you're totally right. Like you're not going to save more money on taxes than you're spending on your kiddos. So this is just to help kind of subsidize what extra costs you might have as a parent.
Yeah, so let's kind of just real quick talk about the landscape of childcare. And I feel like to a lot of parents who are listening, I'm just totally stating the obvious. Like this, right? Childcare costs are going up. They're going up a
Mm-hmm.
lot. And that's because there's a shortage right now of facilities. And I kind of think that makes sense to me because think about what goes into childcare. I mean, it's difficult and you're not well
Mm-hmm.
paid for it. You're not paid very well to care for, developing minds, a bunch of them screaming for your attention at the same time. I can barely handle two. I don't know how people can handle like a whole room full of them. And that's the thing, is that these ratios are very big as well. I mean, you have one person to, how many kids. So demand is high. It's not a lot of facilities. And so I kind of pulled up here just some stats from like the DOL and the census. And in higher population counties, which is where a lot of our listeners are from, the average for infant-based care costs is $15,000 a year for just one child. And that to me seems a little bit even on the low end for a high population county.
That's about, what is that, 12.50 a month on
Yeah.
average. So that could literally be a rent payment for somebody.
It could be you trying to like get close to maxing out your 403B. It's like a whole retirement
Mm-hmm.
contribution right there. Just for childcare. And then if you have multiples, it's even worse. And I'm thinking too, like someone who's a resident physician, I mean, they probably really need to rely on their village if they even have a local village, right? Because I mean, these costs, it's like, this is why we're seeing a lot of student loans. I mean, people are borrowing so they can live. There
Mm-hmm.
are some credits and deductions, right? And I think our viewers know the difference between a credit and a deduction, but just kind of real quick differentiation. A credit is a dollar for dollar reduction in what you owe in taxes. So income, we need to figure out your taxable income to calculate what your tax bill is. Credit goes right towards your tax bill. So there are a lot of different things out there. And what's frustrating about them is that the age requirement, right? The age for your child, it is not unified. So, what the age needs to be for your child to qualify for the child tax credit is different than the age of your child for the child and dependent care credit. It is not unified. There has been a push within Congress to fix that, but I think they have bigger fish to fry right now. Maybe that's an understatement. We're in an election year.
Because the child tax credit, it's you could take that if you have a child under 17, but then child independent care credit, you can only take if you have a child 13 and under, you're referring to, like the
Yeah.
age difference there. Okay.
Yeah, so maybe we get into that. So child tax credit, you get that 2,000 per qualifying child. So they need to be under the age of 17. They have to be under the age of 17
Mm-hmm.
by the end of the year. Qualifying
Mm-hmm.
child is a distinction. It means something within the Internal Revenue Code, and we won't get into that today, but just kind of for most people, that's what you need to know. 2,000 per child under the age of 17. This last tax filing was the first time that I got to take the child tax credit. I got 4,000 because I have 2 kids, and let me tell you, it didn't really move the needle much at all, considering how much we spent on diapers and formula and all the other things, all their clothes. It was just definitely more
Mm-hmm.
than 4,000.
And there is a phase out too. So not everybody can take it. So the modified adjusted gross income phase out is 400,000 for married filing jointly. So if you and your spouse are filing taxes jointly, 400,000 or less, you can take this credit. Above that, you can't at all, right? It totally phases you out.
Actually, there is a phase out, and it's $50 for every, the benefit is reduced by $50 for every 1,000 you earn over the threshold. We do have a lot of student loan borrowers, though, who are doing married filing
Mm-hmm.
separately. And so that phase out is going to start at 200,000. Now, keep in mind, though, that I'm guessing for most of you, part of your strategy is to go back and amend your tax return. And so maybe you hit a phase out, but then when you go back and amend your return, you may be able to recoup more of the credit, right? Depending on what your joint income is with you and your spouse. There's
Mm-hmm.
also a refundable portion. So when a tax credit in general, when you hear the word refundable, that means that if your tax liability is totally wiped out, right? So we're like at zero, we don't owe anything, and you didn't get to take all of the credit, you'll still get back some of it as a refund. And so that means like even if you have no tax liability, you can still take up to 1,700 as a refundable credit.
So this is why folks with like really low income, like maybe the first year they started their job or started their business, like it still totally makes sense. Definitely still file a tax return. Or like the first year you graduate from school, like you're not making barely anything, you might still be eligible for certain refundable credits, such as this. Like this would be an example of one if you have kiddos.
I think for most people, even if you're like, in residency, well, if you're in residency, you're gonna make more than standard deduction. But let's say someone who, whatever reason, maybe you're taking a sabbatical and you don't
Mm-hmm.
have a lot of income and you're thinking, well, I don't need to file a tax return. And even if that's true, there's a lot of reasons why you still should. Like, for example, the IRS only has a certain amount of years that they can go back and audit you from when you filed a return. So if you just want to get that clock started, file an informational return. Or if you want to recertify your income, maybe you didn't have any, or recertify your student loan payment because you didn't have any income, it would probably be easier if you just used a tax return that showed you had no income. You can do alternative documentation of income, but it's probably going to be easier just to use the tax return. So go ahead and file one. So next up is the child and dependent care credit. So you probably heard because, this is our spinoff series from the Student Loan Planner podcast. So you probably heard us talk a lot about married filing separately. And we say a lot, hey, this is a credit that you lose. Big asterisk next to that. You might not lose it if you legitimately are doing married filing separately because you have a divorce decree or separation decree, or you're going to get divorced. There are some exceptions, and you remember this in taxes, there's probably an exception. So if we say, hey, you might lose this, you also might not. So there's an exception for everything.
Mm-hmm.
But for most people who are doing married filing separately, you probably will lose this credit unless you go back and amend the return to married filing jointly. So what the child and dependent care credit is it's a way to kind of recoup some of the costs that you spent trying to get childcare, right? And it's not for
Mm-hmm.
like a stay-at-home parent. The intention is you're trying to seek employment or go to your place of employment. So it's supposed to facilitate that. So a lot of expenses will count. They won't let you do things like overnight camp. I've had clients ask that before. Can't do it. You can do a day camp because they can consider that like a daycare sort of thing. So
Mm-hmm.
there's a lot of stuff you can use this for. Qualifying child under the age of 13. Okay. So for the child independent care credit, the requirement is that your child was under the age of 13 when the expense was incurred. So even if later in the year they
Mm-hmm.
turn 13, the expenses after that point won't count, but the expenses before that, you can still count towards the child independent care credit. When you are doing your taxes, your tax person is going to ask you for a TIN, a tax identification number for the person or facility that is providing the care. And I like to say person
Mm.
because you can use this for like, mom's watching the kids, right? That still counts as an eligible
Mhm.
expense, right? So you can count that towards the credit. So it could be, your parent, you have a nanny, whatever, or if you're at like a daycare facility, but you need a TIN for that. If
Mhm.
it's a person, you might need an EIN or you can use the social.
And so if you're paying somebody under the table, you can't take this dependent care credit
That is
because they
correct.
don't have a TIN.
Because they don't,
Right.
you're not reporting anything. We are not advocating for anyone to, not report stuff
Yeah,
on their
absolutely
taxes,
not.
but just know you're not going to get that credit if you are paying someone under the table.
And in essence, like this is meant to help reduce, you are paying for these costs of dependent care for your children so you can work, so you can earn income. And of course, there comes some kind of expense with that. So it's meant to minimize that expense or kind of reduce it a little bit with this credit that you're getting, or the dependent care credit.
And there is a
It
portion
is
of
a
the credit
little.
we're not going to talk about today. So note that it's
Mhm.
called the child and dependent care credit. So we're talking about
Yeah,
the child portion today. You can sometimes have a relative as a
a
dependent. You can have
parent.
like a
Hmm.
parent, an elderly aunt. They can be dependents and you can get a credit for that potentially. It's less, again, not going to talk about today, but just know that that exists. Talking about
Yes.
kids.
So the calculation is a little interesting. It's not a clean, like what we just talked about with the child tax credit, 2000. It's not a clean like dollar amount like that. It's more so you have to figure out how much did you spend on these eligible expenses, and you can take 20% of those expenses if you earn over 43,000, right, of income,
So if you earn less
and
than
then
that, which is probably not most people listening today, but if you
yes,
earn less than that, it's actually 35%.
and then the first 3,000 for one dependent, you could take 20%, or basically the credit is 20% of the first 3,000 for one dependent, or 20% of the first 6,000 of those expenses if you have two or more kiddos. So the
That is
maximum credit, when
huge
you do the
bummer
math,
because it's like two or more. And I'm like, there's a big difference between what you spend on two kids, what you spend on three, what you spend on four. One of
yeah,
our
five.
colleagues, yeah, we have one of our colleagues has 5 kids. They don't care what we spend.
Yep.
20% up to the first 6,000 that you spend.
So that means max credit would be about $1,200 that you can take. And you can take the child independent care credit with the child tax credit, correct?
Yes, that is important to
Mhm.
note. So even though by themselves these are not like big credits, it can add up. It's still real
Mhm.
money.
Now, downside though is we cannot take the child independent care credit if we're filing taxes married separately. So that's a little bit of a stinky part of this in particular, but the child tax credit is still on the table if our income falls below those phase out thresholds.
Exactly. And then the MFS exception is if you are separated, living apart, or otherwise considered unmarried.
All right. Well, so a lot of employers offer benefits, of course, through work. So healthcare benefits, HSAs, FSAs, and with FSAs could potentially come an FSA dependent care account, right? Are you familiar with these, Tim?
Yes, I am familiar with these. There's a lot of types of FS, well, not a lot. There's several types. There's also like a limited type of FSA, but dependent care FSA. So this is important to note because the first two things we talked about, you can take them both at the same time. And even though what goes into it can be a little bit convoluted, they're more or less straightforward. Once you get the dependent care FSA into the mix, now you have to really track your expenses because you cannot double
Mm,
dip, right? So the
yeah.
expenses that you are using to compute your credit for the child and dependent care credit, you cannot also use to reimburse yourself for the FSA from this
Hmm.
FSA. So if you're reimbursing yourself from a dependent care FSA, that is fine, but that is already pre-tax money. So you're not also going to be
Hmm.
able to go back and then get a credit for those expenses. So just keep that in mind. That's maybe an unnecessary distinction because again, most of us are spending so much on childcare that you can probably still do both. There's also only so much that you can contribute. 5,000 if you are doing married filing jointly, 2,500 married filing separately. Let's talk about this because this is confusing for some folks who are doing married filing separately. We get a question a lot. Can me and my spouse both do 2,500 each? Yes, but there's some conditions. You each have to
Of
claim a
course.
child on your taxes, right? So it's like if you have, I'll
Hmm.
use myself as an example. I have 2 kids. If I'm doing married filing separately and I am claiming both of my children, right? But my husband is not, my husband cannot also do $2,500 into dependent care
Mhm.
FSA. If I claim a child and he claims a child, then that works. Now, as far as
Mhm.
who should claim the children, right? If you're doing MFS because, student loans or some other reason, you might want to talk to a tax professional to decide who should claim the kids or how we divvy that up, because it's going to depend on your situation. But just kind of know those numbers: 5,000 married filing jointly, 2,500 married filing separately.
And if someone accidentally has contributed, what is the situation for amending that? Is it just simply that we don't get the deduction? Like we get the tax form, but when we're filing taxes, it realizes, oh, well, we can't take this. So it's, we're just not going to take the deduction. Is that
It will be considered taxable income. It gets added to your
Mhm.
income because you're doing this as a payroll deduction, so you're already kind of getting a tax benefit that way. So, and I've seen this on
Yeah,
several returns, so it'll show up as like other income, and it'll just say, what
got
that
it.
situation is.
That makes sense. So it'll remedy itself in the tax filing process
Well,
if there's an oopsie, like if you didn't know.
so if you're not
Yep.
eligible to
Hmm.
contribute, then don't. Or if you're
Yep.
contributing too much, then stop those contributions if you can.
And the nature of the FSA too, right, is we have to use that expense in that year. So you'd only really want to be contributing to this if there is some sort of a spillover from those other like credits or deductions. But generally, like you said, cost of childcare is pretty high, so you might want to be utilizing this bucket if possible, and reduces your taxable income if you're able to take the deduction, and that reduces our student loan payment. So that's a win-win right there.
I love it. One thing I need to note, because I see this a lot, and when I say a lot, I mean it's probably less than 50%, but still more than the general population. I see this a lot with physicians, is those numbers I just said: 5,000, married filing jointly, 2,500 married filing separately. It actually can be lower than that. So the Dependent Care FSA is subject to discrimination testing. There's a lot of plans out there. They are subject to different types of tests to make sure they're in compliance with, federal regulations, blah, blah, blah. The point and the reason they call it discrimination testing is because they do not want these plans to overly favor what's called a highly compensated employee, which most physicians would be
Mm,
considered a highly compensated employee. And so what can happen is the plan undergoes discrimination testing and they find out, oopsie, like all of our physicians contributed and like none of our, CNAs or other
other
staff, like
staff.
they
Hmm.
didn't contribute or they didn't contribute as much. So the plan is now top heavy towards these employees. So what they may end up doing is make you take like a distribution, or more
Hmm.
commonly, to keep the plan in compliance in the first place, to keep it from failing discrimination testing, they just limit how much you can contribute. So I've seen some folks who, instead of being able to contribute 5,000, they were capped at like 3,000
Hmm.
or even less. So those limits, those are the IRS, caps, but your actual plan, what they allow, it could be less.
Well, it makes sense now, but it's an unfortunate thing. How do they know, though, that there is some type of new limit versus the like IRS limit, the 5,000, for example? Like, how would you be notified that there's this type of limit because of the
Usually
discrimination testing?
what I have seen and experienced personally is like with open enrollment, they'll put out a brochure is what they should do. And the
Hmm.
brochure, it'll tell
Hmm.
you like these are the maximums. And they should lay out everything like, hey, this is what you can do in your 401k or 403b, all your options. Otherwise, I imagine that they may just send out like an HR email, or you might get like a
Some kind of
notification.
notice.
But hopefully, if you're working at like a reputable employer and they have like a good HR system in place, like they've
Hmm.
already built in the limit, as opposed to
Hmm.
like you finding out afterwards there's an oopsie.
Like, if you're trying to strategize, like, should I be starting to contribute to this dependent care FSA or HSA or like whatever your employer provides as part of their benefits? Like, great conversations for you to have with your financial advisor.
They can kind of go over with you what's more valuable for you in your situation if you have to pick and choose.
Tell me about Schedule H.
So this is for our folks who are hiring a nanny or really any household employee. So I guess there's lots of types of
Mm,
household employees you can have. I guess you can have like a chef and
hmm.
like a full-time gardener, and I don't even know what other, a pool
Or
guy,
thinking about all the things I don't have right now. That would
housekeeper.
be
Yeah.
nice though.
Housekeeper would be
Hmm.
good.
Okay,
Yeah.
so this is where you report the earnings of that household employee,
Yes,
right?
you have to
To
pay taxes
Yeah.
on it, right? You have a household
Hmm.
employee. guess what? You're an employer and you get to pay taxes. And so Schedule H is where that goes. By the way, even if you have, for whatever reason, no filing requirement in your situation, if you have a household employee and you need to do a Schedule H, you have a filing requirement. So if you have to do a
Mm,
Schedule H, you have
mhm,
to file your taxes. Now, you don't need to do this if the nanny or whoever it is, if they earn less than 2,700. So there is that kind of threshold. But that person
mhm,
will still need to report it on their own tax return, even if it's less than 2,700. So if you have a household employee, you may need to make quarterly estimated payments because you are paying the employer portion. You're an employer. You're going to have to pay the employer portion of Social Security and Medicare. And
mhm,
you also get to pay the unemployment tax, which is usually 6% on the first 7,000 per
mhm.
employee. And so for
Got
someone
it.
in this situation, if you know you're going to have to do a Schedule H, or you just found out because you're listening to us today, you may want to use one of those nanny payroll services. There's a bunch out there online. There's like
Is
nanny pop
there?
it. There's
Okay.
nanny pop-ins and a bunch of other ones. I'm not promoting any of them, but
Mhm.
just know it's out there and it can probably make your life easier and they can do a lot of that withholding for you.
Got it. Oh man, that was a smart niche for somebody to get into. Somebody in tax or somebody smart with business. They were thinking, there's not businesses out there doing this. This might be something I should do. And then sounds like they popped up a lot in a lot of other areas.
Yeah.
That's
I
cool
guess
though.
it's like you're trying to precipitate what someone's need going to be and then start a business for it.
Hmm.
And you're either going to sink or swim.
Yeah. Well, I think this was helpful for me. I feel like for someone who does not have children yet, like breaking this down and understanding like what is an option tax wise is helpful because it is such a like, that's a lot of our clients too when we're chatting about financial planning and goals for the future. Like the costs of child care or the cost of like raising a child like are definitely part of the I'm not going to say concern, but just are part of the conversation because it's going to be a change in somebody's budget. So it's nice to know, these little tips and tricks when it comes to taxes on how we can minimize or subsidize some of the costs and be aware of like what we should be doing too if we've got some household help or we've got childcare help because this stuff I don't really think this stuff is talked about a lot, not in these ways. I feel like we talk a lot about retirement. We talk a lot about student loans, of course, because that's a lot of our bread and butter. But diving into like the childcare stuff, which is such a big expense in so many people's cash flow, like it is really important. So this was,
And
I feel like,
also there's
a great
the
episode.
emotional part too, because every parent wants to do what's best for their kids. And so
Hmm.
sometimes it's not a financial decision. It's, you're going to send your kid to wherever you think is the best place. And I definitely relate to this a lot now that I'm a new mom, because like I work in finance, like this stuff it comes easy to me.
Hmm.
When it comes to my kids, I don't even think twice. I'm like, they need that, or I want to get them that. I just do it. And then, kind of in
Hmm.
retrospect, I'm like, dang it, did they need that? Do they need to have the best everything? That's why
Hmm.
it's helpful to always have like I think a third party to bounce this stuff off of and take a little bit of the emotion out.
Very helpful. Well, thanks for enlightening me. I don't have any of these credits with my fur babies. I wish we did, right? I think a lot of people would wish that.
I wish you
But
could even get it for like even just pregnancy. I've been pregnant a lot. If you've been around this podcast, you know my story, been pregnant 5 times. You get a lot, you
mhm,
incur a lot of medical expenses, right? Just trying to
yeah,
like go through
doctor's
that process.
visits, like health, like maintaining your health during that time.
The
And,
extra food you eat, so much food.
what were your cravings when you were pregnant?
I mostly didn't have cravings early on. I really, really wanted oranges, which I think meant that maybe I
Mm,
needed more like vitamin C or something, but I
interesting.
really enjoy
Okay.
eating soup, really just anything. I try to focus on protein. Maybe a lot of our physicians will
Hmm.
appreciate that. I try to focus on protein and I watched my carbs because I was afraid of gestational diabetes, but I still ate some because I didn't want to have like, a problem.
Yeah, that makes sense. Oh,
Yeah.
I had a friend who was addicted to vinegar on French fries, which I thought was a really interesting combo. I
That sounds
love,
like vinegar chips, right?
yeah, I was gonna say I love like salt and vinegar chips, and
Mm.
that's technically the same thing. It's just squishy because it's fries and vinegar, but I don't know, or maybe crunchy enough if they were, but
That sounds good.
very
Maybe
interesting.
I'm gonna say maybe I'm pregnant again. That sounds really good. I'm just kidding. You heard it first, folks. No, I'm
Check
just
back
kidding.
in 2 months. Just kidding.
Thank you everybody for joining in today. Remember that your net worth is not your self worth. This podcast is for informational and educational purposes only and should not be considered individualized financial advice. If a specific investment is mentioned, it should not be considered a recommendation or endorsement to buy or sell the investment. You are encouraged to seek the advice of a financial professional before implementing any investment strategies discussed. All investments involve risk. Past performance does not guarantee future results.